Buenos días a todos. Muchísimas gracias por acompañarnos esta mañana para escuchar a Alan Ernst, que es nuestro jefe del equipo de especialistas que tenemos para renta variable emergente. Y la idea que tenemos en este desayuno es que entendemos que hemos tenido a la renta variable emergente muy aparcada de nuestras carteras. Nos ha dado mucho miedo entrar porque no veíamos ninguna señal clara que identificásemos como una señal de entrada. Y es cierto que probablemente ahora mismo no podamos garantizar que sea el momento de entrar, pero lo que sí vamos a poder entender con el discurso de Alan es qué tenemos que seguir muy de cerca para saber cuándo va a ser o cuándo va a empezar a ser ese momento de entrada el más apropiado. Esta conferencia va a ser retransmitida en directo por el canal de Unience, con lo cual le damos la bienvenida y le damos las gracias también a todos los que se están conectando online en directo. Y Alan Ernst va a hacer la presentación en inglés. Tenemos traducción simultánea para los que queráis escucharle en español. Podéis hacerle preguntas tanto en español como en inglés a lo largo de la presentación. Él está encantado de que le interrumpáis cuantas veces sea necesario y que llevemos el discurso a lo que sea más práctico para todos vosotros. Alan, the floor is yours.
Thank you very much, Inés. And good morning, everyone. Thank you for coming along. Wow, it's a bit loud. Thanks for coming along this morning. We're going to have a talk about our views on emerging markets. As Inés mentioned, this is being streamed, and Pilar's told me I can't move from here, so I normally walk around, but I'm going to probably stay put this morning. As I'm sure you're all aware, emerging markets have not really performed particularly well relative to developed markets for a while now. So we're going to have a look at some of the reasons why that's happened and what needs to change for emerging markets to do a little better, because we think we're at an interesting point now in emerging markets, but there are still some headwinds that need to fade before emerging markets can start performing. We've put up here on the screen 6 key issues that have really been holding emerging markets back and have really prevented emerging markets doing better in the past. And really, of those 6, there are 3 key issues that are really central. The dollar, what's happening in China, and earnings, to my mind, are the 3 key reasons why emerging have not performed better. The other 3, what's going on in commodity prices, what's happening with some of the more fragile economies, and sentiment, are really linked in one way or another to those 3 key points of the dollar, China, and earnings. So I'm going to focus really on those 3 points, and we'll tie in the others as we go through. Why is the dollar important? The dollar matters in emerging markets because it's the global reserve currency. 80% of trade is done in dollars. 75% of financial transactions are in dollars. And emerging markets still rely on capital flows and dollar growth and dollar earnings. Now, you can see on this slide, the orange line is the trade-weighted dollar inverted. So when the orange line is heading down, the dollar is strengthening. The blue line is the relative performance of emerging markets versus developed markets. And you can see, as the dollar's been strengthening, really, for the last 18 months, 2 years, very strongly, but even a little bit before that, emerging markets having outperformed significantly through the commodity super cycle and the rise of China in the early 2000s to the peak around just after the financial crisis, we've had relative underperformance. And that's been going on now for about 5 or 6 years. In an absolute sense, the emerging market index has really been going sideways. It's been bouncing around in a range. But relative to developed, it's been a big underperformer. Actually, it's more to do with the US equity market, but even against Japan and Europe, emerging's been relatively disappointing. And you can see that there is a very close relationship here. So when the dollar is strong, that's a headwind for emerging markets. Now, that relationship is perhaps not as strong as it used to be. In the 1990s, when emerging markets, more emerging markets had their currencies either pegged to the dollar or they managed very tightly against the dollar, and those economies relied heavily on short-term external financing, that relationship is beginning to break down. More currencies are now free-floating. More funding in emerging is from long-term local sources rather than short-term external dollar funding. But nevertheless, there is a very strong relationship. Now, in the first quarter of this year, we saw the dollar weaken a little bit, and no surprise, emerging did a little better. So one of the key issues is really, has the dollar reached a peak now, and is it going to begin to stabilise? One of the reasons why the dollar has been strong is the dollars available has been shrinking. As Bernanke announced the withdrawal of QE, we've had fewer dollars around. Demand is out there, and that's pushed the dollar up. Now, we think the dollar is beginning to peak out here. What's interesting also on this slide is if we look at the currencies that have been particularly weak against the dollar, in the emerging world, it's mainly the commodity currencies. The blue line here is the performance of emerging commodity currencies. So the rand, the real, the ruble have been extremely weak, particularly last year. Some of the manufacturing emerging currencies, the won, etc., have performed more in line with other G10 currencies. So the dollar's been very strong in recent years against most currencies. It's been particularly strong in the last 18 months and particularly strong against commodity currencies. But we think that's now starting to fade. The reason why is because although we've got divergent monetary policy now, with the Federal Reserve already having tightened once, likely to tighten again, we think, over the next 6 to 9 months, as the US economy is performing reasonably well. It's not super strong, but it's not too bad. And the output gap in the US economy appears to have closed. If we look at labour data, the labour market is reasonably tight. Wages are starting to improve. The economy is growing at an okay sort of rate. And inflation is beginning to pick up a little bit. So we think eventually the Fed will have to push rates up a little bit. But we don't think it's going to be a very powerful rate tightening cycle. Elsewhere in the world, in Europe and Japan, monetary policy is still going to be very loose. So that differential in policy may provide a bit more support to the dollar. But the dollar has gone a long way. And historically, when the Fed have started to tighten, it's usually coincided with a peak in the dollar. In other words, investors are typically anticipate that tightening move, and that's usually around the peak of the dollar. As we've said on this slide, a lot of currencies have been very, very weak, and there is room now, we think, for the dollar to stabilise. So that will be one big headwind that's removed. Stabilisation in the dollar will, we think, give an opportunity for emerging markets to start outperforming on a relative basis. So in other words, relative to other equity markets, if the dollar has peaked, emerging can start to do a little better. But that's not enough to get good absolute returns. That's going to depend really on what happens in China and particularly to earnings, which we'll come on to. In terms of China, the issue for China is really summarised on this slide, which is looking at nominal GDP. And you can see that through the boom years, with the exception of obviously the big dip during the financial crisis, nominal GDP in China was running at around 15% plus for several years. We're now down at about 6 or 7%. And that's a bit of a problem because credit growth in China is still running at 13 or 14%, which means that the debt burden in China is going up quickly, and with credit rising faster than nominal GDP, that debt burden will keep going up. Now, we don't think it means a major financial problem in the near term for China, but they cannot continue to push credit through the economy at this rate if nominal GDP stays down here. They will have to address that debt at some point. But we do think China has got much more room to manoeuvre than the pessimists would believe. What's also going on in China is a big shift in the structure of the economy. There's been a lot of talk from the Chinese authorities about reform and about moving the economy more towards a consumer-based economy. China has been reliant on fixed asset investment for a number of years now, as well as, of course, exports. But China's been spending 40-45% of GDP on fixed asset investments for a number of years, and they can't continue to do that. They need to shift to a more consumer service-oriented economy. The good news is it's already happening. On this slide, we're looking at the tertiary sector, so services, and the change in their share of GDP over the last 7 or 8 years. And you can see there's been a big shift towards services. The problem in China is in what we would term old China. It's the big, heavy industries where there is massive overcapacity. So areas like steel, cement, coal. This is the area where China is trying to shut down that capacity and shift the workers into the service sector. As I say, the good news is it's happening. Services are now a bigger part of GDP in China than the old China, as it were. But nonetheless, that move to that attempt to shift the economy is going to take a long time. It's not going to be straightforward. There will be bumps along the road. But every time the economy starts to slow, as they reform the big industries, shut down some of that capacity, that will have an impact on the labour market, and then the government react by stimulating again. So in many ways, China's moved to this new structure. You can think of it as 2 steps forward in terms of the reform and restructuring, and then 1 step back when they need to step on credit again to dampen the impact of that change, because as they change, it means people are being moved out of those old jobs and being transitioned into new jobs, and the economy starts to slow. And the one thing that we need to keep an eye on in China is the labour market. Whether China's economy is growing at 7% or 5% or 4% doesn't really matter too much. What matters is, are there enough jobs being created? Are there more jobs relative to people looking for jobs? Are wages still and living standards still rising? If they are, then the leadership will be happy because they can stay in power. If there is a threat to that, then they'll have to stimulate. And that's what's been happening last year. We're seeing the effects of stimulus from last summer beginning to feed through in better data at the moment. But that reliance on credit-driven growth, as I mentioned earlier, can't continue forever because the debt burden is going to continue to rise. In terms of the performance in the export markets, although it looks like a very small little bump on this chart here, the reality is, compared to other economies, China's exports have not really suffered too much in terms of their market share. The Chinese currency has been pegged to the dollar, so it's followed the dollar and has become probably a little overvalued. Wages in China have risen a lot, but nevertheless, China's export competitiveness is still there. The reason it's such a small figure is not because China is losing share in the export markets, it's because simply a lack of demand. Global growth is not particularly strong, so exports everywhere have been quite weak. So China doesn't really have a major problem in exports. If global demand picks up, China will participate in that. The problem in terms of debt is highlighted on this slide. Debt has been rising quite quickly over the last 7 or 8 years since the financial crisis. Around 200%. It's actually a little higher now. This is slightly out of date. But a lot of that debt is in the corporate sector. And a lot of the corporate sector debt is the state-owned enterprises. So again, really all of this flows back to the government. Going back to a comment I made earlier, the government can continue to push credit through the system to dampen the effects of the structural shift. They've got room to manoeuvre for some time, we think, but at some point they're going to have to address this. And remember, the Chinese government still have control over a lot of the economy. The major banks are still majority owned by the government. So if the government want to stimulate, they push credit through the banking system. Now, the bank's official non-performing loan data is around 2%. The unofficial data is probably much higher, in the mid-teens probably. That means that at some point, a lot of that misallocated capital that has occurred through this credit push over the last number of years will need to be written off and addressed. So it's quite likely that the government will have to step in at some point and recapitalise the banks. They're already engaged in a debt for equity, or a debt swap. A lot of local governments that have been borrowing from banks are now swapping those loans for debt. There'll be debt for equity swaps as well. So it's, again, this is all happening. It is already happening in the system, but a more formal bailout, it can't be ruled out. We don't think there's going to be a major problem in the banks in the near term, but this debt burden can't keep rising forever. The other piece of good news, I suppose, which has helped commodity prices, is the property sector has started to improve again. Slide 11 shows the situation for the major cities. The orange bar looks at is the number of cities where property prices are increasing. The blue bar, the number of cities where the prices are decreasing. And this is the Tier 1 and Tier 2 cities, the top 70 or 80 cities in China. And you can see that the number of cities where prices have started to increase has been rising steadily over the last few quarters. So the property sector is certainly in better shape than it was a couple of years back. The Tier 3 and Tier 4 cities, there's still a lot of oversupply. Now, why is that important? That's important for commodity producers because Chinese property development is a major consumer of industrial materials. So the reason we've seen a bounce in the iron ore price is partly because iron ore prices became arguably very oversold, but also data out of China has improved, and that's helped support those prices. So in conclusion on China, I would say we're in the more optimistic camp. There are a lot of pessimists about China, but what we see is the problem in China is the non-service old China and this ever-rising debt burden. On the positive side of the ledger, we've got services which are doing extremely well. Internet, tourism, all of those areas of the economy are booming, and they are now a bigger part of the overall economy. The property market is stabilising, and the government still have control over the economy and room to manoeuvre. So if China's going to have either a hard landing or a financial problem, it'll probably be because of a major policy mistake. And at the moment, it doesn't look as if they're going to make that major mistake just yet. Overall, we think China continues to muddle through. The politics in China is always very murky, but it does appear as if the leadership under Xi Jinping does want to see this reform program continue. In fact, there was an article in the People's Daily a week or two ago, which is the official mouthpiece for the government. So that article wouldn't have been published without clearance from the very highest level. And that article was quite critical of the pace of change. So the senior leadership do want to keep pushing through on reform, but there are some vested interests that are holding it back somewhat. So you need to keep an eye on politics. But overall, we think the chances are China muddles through. Growth will continue to gradually slow, but as I say, as long as the labour market remains intact, then that won't be a big problem. You can see that impact on commodities here. China accounts for 50-60% of global demand for a range of industrial commodities. Less so for oil, but particularly for the big industrial commodities. And most of that is driven by property. Infrastructure spending is obviously part of it, and the government have been pushing through a lot of infrastructure spending, again, to help support the economy as it shifts more to a service sector economy. And that has certainly given a bit of support to the likes of Brazil and Chile and South Africa. The problem in the commodity market, though, we won't spend long on this, but the problem in the commodity market is demand remains quite weak. Global demand is still fairly anemic. China is shifting away more towards consumption and services. So at the margin, demand is not as strong as it was. And at the same time, we've had plenty of supply. In the oil market, inventories are at high levels. Iran's coming back into the oil market. Saudi are defending their market share. Shale oil and shale gas have obviously come back somewhat since the oil price collapsed recently, but that can be brought back on pretty quickly. There's a lot of shale wells in the States that are semi-completed, where the operators have already proven the reserves in the ground, but they just haven't completed the wells because the oil price dropped. Now, if the oil price goes back above 50, some of that will probably come back on. So there's plenty of supply and not a lot of demand. And the same is true in other commodities. Iron ore, I mentioned earlier, China is a huge huge demander of iron ore, less so than it was. But of course, through the super cycle, the companies like Rio Tinto, BHP, Vale in Brazil start to plan new supply on the hope that the Chinese demand will keep continuing well into the future. And now that that's changed, a lot of that supply is just coming to the market. So you've got a supply-demand imbalance which will take a few years to work through. So we're not particularly optimistic that we're about to embark on another big boom for commodities. We've seen a strong rally in the first quarter in some commodities, coming from a very oversold position. But the supply-demand situation would suggest that that's going to run out of steam fairly soon. The third key point is earnings. I mentioned earlier it's the dollar, it's China, and importantly it's earnings. And this is really what we need to see change to get some strong absolute returns from emerging. Slide 16 looks at the earnings revisions across the emerging market index. So for the MSCI EM index, the number of companies with negative earnings revisions versus positive has been pretty poor for quite some time. So companies have just not been able to generate a lot of earnings growth and have been disappointing, and analysts have had to revise down their numbers. And you can see that clearly on slide 17. Each of these lines is the path of consensus earnings estimates for each of the last 6 years. So if we look at 2012 as an example, analysts started the year very optimistic, thinking that emerging market earnings over the next 12 months will grow at 12-15%. They then spend the rest of the year revising that number down, and at the end of the year, we end up with zero earnings growth. And you see the same pattern repeated year after year, 13, 14, 15, and the same thing is happening at the moment. So analysts want to be optimistic. They want to forecast strong earnings growth. But the reality is emerging companies have just not delivered on earnings growth. And that's one of the key reasons why emerging markets have not delivered better returns relative to the developed markets. Earnings have been broadly flat. Now, companies not meeting their forecasts, analysts being too optimistic. Part of this is a reflection of companies and governments not really coming to terms with this low growth, low return environment we're in. If we start to see a turn in that trend, either because the dollar is particularly weak, which would help. We're not expecting the dollar to be weak. Stabilisation would be helpful, but a very weak dollar would certainly help dollar earnings improve. What would be better would be stronger global growth. There are some signs that the global economic activity, certainly in the US, is looking okay, but elsewhere is still fairly anemic. So that's not providing a lot of support, which means that emerging companies are going to have to get more efficient at running their businesses. And in particular, emerging governments have got to continue the reform programs that they've announced. We've seen decent progress in reform in countries like Mexico. China is certainly on a path of reform, albeit a sort of stop-start type approach, but China is gradually reforming. Modi and the BJP were elected in India a couple of years back on a reform program. And again, in India, there's been some progress, but investors have been a little disappointed at the pace of that progress. But it is happening. And again, in Indonesia. So we are seeing signs of reform coming through. Investors always want it to happen quicker than it can often be achieved. But supply-side reform, making business conditions easier for companies, it's beginning to happen selectively. Other countries have shown no real signs of reform at all, and they need to. So Russia, Brazil, South Africa, for example. But reform programs and some self-help from individual companies is going to be important to get that turn in earnings if we are going to continue in this low-growth world. So we're reasonably optimistic that the dollar is found, has peaked or close to a peak here, which will help the relative returns. But we do need to see a positive change in trend on earnings to get some strong absolute returns. In terms of the vulnerable countries, there are still a few around, like South Africa, Malaysia, Brazil, but these are countries that are still reliant on external funding. They're running large current account deficits, but generally speaking, emerging's in much better shape now. Current accounts positions have improved markedly over the last few years. In terms of sentiment, I think you all know emerging markets have been out of favour for a long time. Last year we had record outflows from mutual funds of around $70 billion. Even some institutional investors are beginning to question the asset class. But I think a lot of that bad news is now factored in through these flows. So where do we stand in terms of valuations? Obviously, given the relative underperformance, valuations are not too bad. On a PE basis, on page 23, you can see that at 11.5 times, emerging markets are trading broadly in line with their long-term average of about 12. So they're not particularly cheap on a PE basis versus their history. But versus the US or other developed stock markets, they do look cheap, particularly against the US. On this next slide, we're showing the Shiller PE of emerging versus the US, versus the S&P 500. And here you can see we're at a very big discount. Now, is that because the US is expensive or because emerging markets are particularly cheap? Reality is it's probably a little bit of both. The US is probably a bit expensive and emerging is a bit cheap on a PE basis. But if you get a turn in earnings, then that can reverse quite quickly. What's more interesting is if we look at the price to book for emerging markets. On a price to book measure at around 1.4 times, emerging markets are right down at the bottom of their historic range. Now, I would probably argue that some of that discount to history is justified, because going back to my point about earnings and the low growth world, returns have been falling across the board in emerging. Return on equity is down from about 16% a few years ago to more like 10 or 11 now. So that would justify, to a certain extent, a lower price to book. But again, if we start to see a change in those trends, if we start to see returns improving, if we start to see earnings improving, then we're at a price to book level that looks very attractive. In fact, on this slide, slide 26, if we look at history in emerging markets and look back at the times when emerging markets have traded at this price to book level before, and then track forward the returns, from a price to book of 1.4 times, the chances of a 19% return over the next 12 months is pretty low. The R squared on the scatter chart on the left-hand side of the page here is not very strong. So there's not a lot of information in this indicator. But if you start to look a little further out, so over the next 3 years and the next 5 years, historically buying emerging markets on 1.4 book, your returns over 5 years, over the next 5 years, have been around 25% per annum. Now that sounds a bit heroic, but the R squared is getting a bit more reasonable. The issue, of course, is that's a 5-year view. The next year or two, you could see further weakness. But if you're prepared to take a long-term view on emerging markets, then the valuations here are telling us that it's a pretty good entry point. But the prerequisite, as I mentioned before, to unlock that value is a change in the earnings trend. We've seen, actually, through... I'll just put that back there. We've seen over the last few years how that lack of earnings has played out within the market. So although the overall index has not done particularly well in either absolute or certainly in relative terms, there are plenty of stocks within the benchmark that have delivered very good returns. For example, in our portfolio, we've had a big overweight position in Tencent, which is a Chinese internet company. for the last few years. That's delivered very, very good returns for us. When we look at Tencent, though, is it a cheap stock? No, it's not. It actually looks very expensive. Every time you look at the stock, you think, my goodness, can we really justify these valuations? But the reason Tencent has done well is because it has delivered on its earnings. It has generated strong cash flow. It has generated returns to shareholders. And companies that can do that have been rewarded. So what we've seen in the market over the last few years is investors of continually gravitating towards quality growth stocks. Companies that can generate returns get bid up. The overall index may look cheap, but there are also a lot of value traps in the benchmark. Chinese banks look cheap, trading on around price to book with returns on equity of 15%. You'd think that looks pretty cheap. But nobody believes the NPLs. So you've got a value trap. Gazprom in Russia is a value trap because you don't know if you're going to get your money back. So you've got to be careful within the market. But the point I'm trying to make, I guess, is that even though we've not had great returns at the overall index level, because of some of these trends, if you pick the right stocks, you can generate returns. And what we've seen in the first quarter is a partial reversal of that. If I just jump forward a couple more slides. Slide 28, looking at the movement in the metals index and oil since the start of the year, having seen a period of a long decline in both metal prices and crude, we've seen a bounce in the first quarter. And that was sufficient to see the commodity markets like Brazil and Chile and South Africa outperform and Russia outperform. It was sufficient to see the materials sector outperform and for some of the value stocks, if you like, to outperform. But since the end of the quarter, that started to reverse again. So just summarising that point, the last few years, the market's been led by quality growth and value has underperformed. The materials sector has underperformed and the energy sector has underperformed. What's led has been IT and consumer discretionary and quality growth. There was a partial reversal of that in Q1, but that's now those trends are switching back to the old leadership again. So to get a real change in trend, you'd need much, much stronger global growth, which we don't see. So we're still underweight materials. We still favour quality growth. We still favour countries that have strong balance sheets rather than weak balance sheets. So, in terms of the structure of the market, I'm just going to jump on a little further. I put a few slides in here on how we actually manage money, but let me move on to this slide. This is not particularly easy to read on the screen, but page 40 shows our current positioning. The green markets are where we're overweight, the red markets where we're underweight, and the orange markets where we're neutral. So you can see here we're overweight China and Korea. We're overweight Brazil. We've just gone overweight Brazil quite recently. We're overweight Russia and a little bit of an overweight to Turkey. The big underweights are to markets like in Asia, Malaysia, Indonesia, India. We like India longer term, but it's just too expensive at the moment. Similarly on Mexico, the top down looks good for Mexico, but it's a very expensive market. And then the big underweight in EMEA is South Africa. So you can see from that broadly, places like China, Korea are running surpluses. South Africa running a big deficit. You can see generally commodities are underweight, materials underweight, and a positive skew towards some of these more manufacturing economies rather than commodity-producing economies. I'll stop there, and maybe we can see if there are any questions that I can answer. So just to summarise, we think some of the headwinds that have been facing emerging are beginning to fade, particularly the dollar. If that's peaking, that's a first sign. China, we think, is going to remain on course for this gradual muddle through as it shifts towards a new structure. So no major problem out of China in the near term. And we're looking for signs that earnings are beginning to improve. They're not there yet, but the longer we're in this low growth world, the more you'll see pressure on reform measures being forced through economies and individual companies. It's about finding those companies that can really deliver on their earnings. So quality growth, we think, remains the right position, and staying somewhat cautious still on the commodity sector. So, any questions on any of that?
Well, just a little question regarding Brazil that you are overweighted. What do you think will happen with? Regarding Brazil that you overweighted, I think that the key right now is the political situation, the impeachment against
Dilma.
Yeah. I think that it will affect significantly what is going to happen in Brazil for the next years, no?
Yeah, I mean, Brazil is a little different. Obviously, some of the trends I've talked about do have an impact. So this recovery, short-term recovery early in the year in commodities definitely helped the likes of Vale, the oil price, certainly to an extent as well. But yes, the overriding issue in Brazil is politics. The reason we went overweight is because we can see the opportunity for some fiscal orthodoxy being introduced, which will help set the stage for rates to come down. But it's not going to be, the economy is still in very poor shape. Obviously, the GDP was particularly weak last year. The interim government of Temer, initially the signs are quite positive. Some of the people that he's brought into government, but the corruption scandal is still ongoing, and there are a number of people in Temer's party that are potentially going to get wrapped up in that as well. So I don't think it's going to be straightforward with Brazil, and the headwinds are still, heavily against the economy, but at least they're moving in the right direction. So the reason we've gone overweight is because there are some very good companies in that market that will benefit if we can get some progress, if we can get the economic measures introduced that will help start healing the economy. But, the years of consumer credit-driven growth and lack of investment need to change in Brazil. So we need to get more investment, and we need the new government to actually set the conditions for that to happen, and a reduction in reliance on consumer. It's interesting, in some ways, Brazil is almost the opposite to China. China's arguably had too much investment in the near term and not enough consumption in Brazil, the other way around. Do we have any other questions? No? One here.
What if the rates cycle in the US goes faster than everyone is forecasting?
It's a very good question. I should have mentioned that actually in my talk. That's, I think, the biggest risk. One of the biggest risks to emerging is if the Fed have got this wrong and they're well behind the curve. If we get a big inflationary push and rates go up much quicker than is expected, the dollar will strengthen significantly. There will be a major risk aversion trade the dollar will strengthen and emerging markets will suffer regardless of the fact that valuations look attractive. So yes, that I think is something we need to watch for. If you look at the futures curve, it swings around depending on which Fed speaker is out at any particular point in time. Earlier this year, when they backed away from the March move, everything was very dovish again, in terms of monetary policy, and the view was there would be no rate increase until maybe even December. The likelihood of a June increase was down at very low levels. In recent weeks, more Fed speakers have become a bit more hawkish in their comments, and the Fed futures are now saying something like a 34% chance of an increase in June, a 54% increase in July is the probability. So it's moving around. The Fed, if you look at what the Fed's expectations are, they've actually gradually reduced. 9 months ago, the sort of familiar with the Fed dot plot, where the Fed speakers say where they think rates should go and where the terminal rate should be. That line was pretty steep, and the market was saying they have no room to raise rates at all, or very little. The Fed dots have gradually been coming down, but there is still a gap. The Fed are saying they're going to tighten more than the market expects. So if there's a surprise, I think you're right, it's likely the surprise can only be a negative surprise. But on balance, we think, although there are signs of inflation beginning to feed through, the Fed won't be able to raise rates without killing off the recovery. So they're going to be particularly cautious about moving too quickly. But you're right, if there's an inflation scare and the Fed will move aggressively in light of that, that would be a big negative for emerging. Any other questions? No? Well, in that case, thank you very much for coming along this morning. I hope it was helpful. If you've got questions that you want to raise with us later, please get in touch and we'll come back to you.
Bueno, muchísimas gracias a todos por acompañarnos esta mañana. Lo que dice Alan, cualquier pregunta, cualquier duda que se nos quede en el tintero, nos tenéis a toda la oficina a vuestra disposición para trasladársela a Alan y que nos la responda con la claridad con la que habla. So thank you, Alan. You didn't move. Thank you so much. Y bueno, lo dicho, muchísimas gracias a todos vosotros por participar esta mañana con Esrodes. Gracias.
Thank you.